in the month of August, Nifty has seen a correction of almost 1.5%. But at the same time, mid cap and small caps have seen correction to the tune of almost 2% to 4%. So there's a clear visibility that there's a lot of money flows which is happening towards large cap, because at this point of time, small and mid caps are looking little risky. Also from a valuation perspective, if one look at both mid and small cap from a valuation perspective are trading at more than their 5-year averages. Whereas if we look at Nifty 1 year forward PE multiple, it is trading near its 5-year averages. So it's giving comfort of reasonable valuation as compared to small and mid cap. But where the real comparison lies is what is happening in India versus what's happening globally. So if you look at from that perspective, index year to date, Nifty index year to date has delivered a return of close to 3% return, whereas at the same time Nasdaq or S&P has delivered almost 10 to 11% kind of returns. MSCI World Index has delivered almost 13% return, and MSCI emerging markets across the globe has given a return of close to 17%. Whereas the Shanghai market or the Chinese market, which has been underperforming both the global markets, emerging market and India market for last many years, has given phenomenal return of almost 27% on year to date. If you move beyond equity market and try to compare returns with what's happening on some of the precious commodities like gold and silver, because of the way most of the central banks have started accumulating gold because of the heightened uncertainty which is happening due to tariff, falling dollar index, and kind of uncertainties which are prevailing on the geopolitical front. We have seen almost 31% return coming from gold, and silver has started outperforming gold and has delivered almost 37% return, not just because it's a precious metal, but also because of the industrial usage which silver is seeing in the EV segment, in the solar or in the renewable energy segment, and because of that there's a good demand supply mismatch which is there, and that's why silver has started outperforming gold and has delivered almost 37% return. So keeping this in mind, and also if you look at the USD INR in the same period has seen a depreciation, almost calendar year till date as rupee has depreciated almost 3%. So that is also worsening the overall situation. So overall we can say that August was a month where we have seen some amount of underperformance from the markets in the absolute term, but there is a huge underperformance versus what's happening globally. A lot of Nifty companies in the first quarter has delivered a return, but these returns are mostly driven by margin expansion or due to leverage. But if you look at the overall volume growth in most of the companies are still missing. If you look at the earning growth coming from Nifty mid cap companies, it is reasonably good, but where the disappointment has come is basically into the Nifty small cap, where the earning growth has not come in line with the broader expectations. So we can say that from an earning growth perspective, Nifty 50 stocks are showing better resilience, and Nifty mid cap companies are showing again good returns, but earning growth. But where the disappointment is coming basically is from the small cap basket. Now, if you look at from what has happened on the GST front, so one thing is very clear: there is a lot of focus in the last 1 year on the consumption side of the economy. Let's begin with what has happened on the budget. So if you look at from the budget, there is a very strong tax bonanza which has happened for income level till 12 lakh, and these tax shops are going to increase the discretionary spending in the hands of consumers. So that's one which is very supportive for the entire consumption as a basket. Second, if you look at what has happened on the GST front, so this year itself government has forgone almost 50,000 crore in terms of GST by reducing the GST rates and rationalizing it to lesser rate. So because of that, there is going to be a positive impact of almost 50,000 crore in the hands of consumers. Next year, the same number could be 1 lakh crore. So basically, the overall consumption is going to get a positive boost because of this GST rationalization. And now, in the next 9 to 12 months, we are going to witness almost 6 states coming out for elections. And because of this, we believe there is going to be a lot of freebies which will start happening, and this will again increase a lot of spending both on the rural and on the urban front. So we believe that a lot of freebies will be given, and again this will be very positive for the consumption. One more thing is, not today but in the next 2-3 years, we are going to see a lot of incremental income coming in the hands of government employees because of the sixth pay commission. So all this is going to increase the overall consumption. And one very interesting thing which is happening this time, despite there's a cut on GST rate, most of the companies are coming and giving upfront indication that they are going to pass all the entire benefit of the GST to the end consumer rather than taking the advantage on their books. So this is also very, very positive, because ultimately the entire GST cut, ultimately we are going to get the benefit, and this is across the board, whether it's the smaller items or it's a high-end consumable item, high-end consumer items like consumer durables like ACs, or even to cars. And it's not just cars which are restricted to the entry-level car, but even a luxury car or a sedan car or a SUV car is also getting the advantage of the GST cut. So we believe that the consumption is going to be a theme, and that's where a lot of focus will be there from an investing perspective in next 9 to 12 month period. When US imposed 25% tariff rate, it was still okay, because a lot of other countries, in fact the competing countries, were also struggling with the same kind of rate. But when we say it is 50%, it's like an embargo. It's like it's going to create a lot of challenge, particularly for industries like textile, chemical, agriculture, and many other sectors will get impacted due to this 50% tariff hike which has happened, particularly in sectors like diamond and jewelry. So all this is going to get impacted. Where we are not going to witness significant impact is first the pharma, because still pharma is exempted from this 50% tariff rate, and that's the reason we have not seen any big selling pressure coming either on the generic pharma or any of the CDMO players. Obviously from the electronic segment also, still that 50% tariff has not been imposed, because if you look at Apple is a big exporter from India market to US and other countries, and because of this tariff exemption, it has not got impacted, and that's why we can see that the entire electronic segment has not got hit because of the rising tariff hike. But there are a lot of discussions going around which indicates that there is a possibility of further negotiations going to take place on the tariff, and in next 3 to 4 months, if we see any kind of advantage coming on reduced tariff rate, then I think market will take it very positively. At this juncture, if you look at from a FII selling perspective, FII's holding in the Indian market has come below 16%, and it's almost 2012 levels, so which is almost 13 to 14 year low situation in terms of FII holding into Indian market. If you look at, FIIs have been consistently selling in the Indian market, and particularly in the month of July and August, we have seen a lot of selling coming, but it is getting absorbed by what is the participation coming from DIIs. So DIIs have been consistent buyer. But one thing which is a little concerning is the way new QIPs are coming, the new IPOs are coming, and a lot of capital market activities happening from corporates. So which indicates that a lot of these institutional investors, large foreign institutional investors, along with promoters, they are reducing their stakes, whereas a lot of buying interest is coming from DIIs. So DIIs are acting like a balance which is giving support on the selling pressure. But at higher end, we are witnessing this selling pressure because of these heightened capital market activities which is happening. So because of this, we believe that markets are going to remain neutral to range bound. Obviously, rupee has seen a lot of weakness in the last calendar year to date. We have seen rupee depreciating almost 3%. So this is also creating some pressure. But our belief is that because Nifty forward PE multiple is close to 5-year averages, we are not going to see significant amount of selling pressure, which means if you look at from a technical perspective also, Nifty has not breached its 200-day moving average, which was close to 24,000, and trying to create a good base between 24,000 to 24,500. But where the struggle is happening is at higher levels of around 25,000 to 25,500. So keeping this in mind, we are very watchful of these important technical triggers. If Nifty manages to hold up its 200-day moving average, which is close to 24,000, then maybe there will be some consolidation. But the possibility of this consolidation giving a breakout on higher side is very, very high. If you look at the GST collections, it's in the range of 7 to 6%, which is a little disappointing. The reason being the GDP growth has been in the range of 7.8% in this first quarter. But because the inflation number is very low, the nominal GDP growth rate is lesser, and that's the reason GST collections are also coming below the nominal GDP growth rate numbers. So that's where we need to be very watchful of how the GST collection starts to take place. So from a market perspective, I think from a valuation perspective, already markets are at a reasonable valuation. From a large cap perspective, little overvalued in terms of mid and small cap. Rupee has seen a depreciation, but at the same time, crude prices have seen correction and they are trading sustainably below 70 mark, which is $70 mark, which is very positive for India economy. As we have already mentioned, the positive impact of GST plus tech swaps, and this is going to positively impact the entire consumption theme. We believe that there are certain sectors where we would like to remain overweight. Within that, I think consumption would be our preferred bet. Within consumption, we will be more focused on consumer durables and EMS as a theme to play the entire consumption. Still, we don't like FMCG companies because there the volume growth is still missing. And even if the volume growth comes, because most of these stocks are trading at 50-60 PE multiple, and if the earning growth is going to be 8-9%, we don't see significant amount of re-rating which will take place. But where the consumption will really happen is space like hotels, space like travel, tourism, or something like ACs or consumer durable as a segment, and eventually segments like EMS. So this is one space which looks very promising. Entire new age theme looks very promising because now this industry is moving from the growth numbers or high growth numbers, but without the bottom line. Now they are focusing on growth or path to profitability, and that's where we have seen how companies like Zomato or Swiggy have seen good recovery in the last 6 to 9 month period. We believe that the entire trend could be witnessed in the entire new age companies. So we firmly believe the entire new age basket looks very promising and time to be little overweight on this space. CDMO in the entire pharma space looks very, very promising because if the entire pharma is going to grow at 8-9%, we believe CDMO opportunities or CDMO companies can grow at 15 to 18% kind of growth rate. So we believe next leg of growth can come from CDMO companies in the pharma space. And automobiles are also a big beneficiary of the entire consumption cycle, and we have already witnessed in the last 1-2 years there was kind of degrowth which was there on the auto segment. So now because of the GST boost, we believe auto could be a big beneficiary of this trend. Two sectors where we are a little underweight or trying to have lesser weight or not having any position is one, the entire IT basket, because here we still believe discretionary IT spending will take a lot of time. And most of these companies are quoting at 20-22 PE multiple, but the earning growth is going to be far lesser than this PE multiple numbers. So we believe markets are not going to reward them very well. And we also believe that the capex intensity might come down at least in next 1 or 2 quarters. The reason being because a lot of focus is happening on spending on GST, on state elections. So a lot of money or budgetary allocation can see a lesser spending towards capex intensity. So maybe very selectively defense or something can do really well, but at a broader level we believe that there would be some consolidation which can happen on the capex team as well. Thank you for watching this video, and please give your comments on the comment box, and would love to meet, would be happy to really interact with you for any kind of queries or market related discussions. And so yes, looking forward. Thank you.